Our next guest, meanwhile, thinks the Fed likely will go, quote, too far in raising rates to tame inflation. David Nelson is chief strategist at Belpointe Asset Management. As we get to David, there's another look at the U.S. pre-market trade where futures contracts are down. David, thanks a lot for joining us. The action has been down so far was down in February. February is now in the books. It was a down month after January's rally. The narrative that the Fed might be willing to cut rates at the end of this year seems to have gone out the window, and you certainly are not a subscriber to that view.
I think markets actually got that message, and markets had done a pretty good job of getting rid of the idea that the Fed was going to cut rates sometime later this year. What I don't think markets were prepared for was the idea that the terminal rate was going to keep marching higher, and that's what it did during the month of February. And then the world turned. The market went from the glass was half full to the glass is half empty. The Fed message right now is that they can pull off a soft landing. In other words, they're saying it's different this time. The history of the Fed speaks otherwise. They generally hike until something breaks. And the problem with that idea, Paul, is that it doesn't take in the lag effect. I read a paper from Atlanta Fed President Raphael Bostic, and he pointed out that Fed policy takes 18 months to 2 years before it even starts to make its way fully through the economy. We're not even 1 year into this. So I do think, though, they will go too far, and it looks like it's headed towards 6%.
Stocks can rally on increasing earnings, the E in the price earnings multiple, or they can rally on expanded multiples, those price earnings multiples getting wider. You don't think this is a market where we're going to see either one of those things, if I understand your notes correctly?
I don't see how you get an expanding multiple with the terminal rate or the risk-free rate moving higher. Consensus right now for this year is about $223 for the S&P 500. That's exactly what we did last year, so you're not really getting the help. I think actually the setup for the second half of the year is pretty good. By July, we're going to be on the other side of the debt ceiling, which is clearly a near-term crisis. But we'll be on the other side of that. And portfolio and fund managers like myself, we're not going to be looking at 2023. We're going to be looking at 2024. And the 12-month look ahead for earnings is going to look a lot better. So there's stories underneath the market for sure, but for the broad indices, it makes it pretty tough.
Let's talk a bit about the debt ceiling crisis, as you've coined it. The debt ceiling, of course, is that standoff that we expect in the U.S. Congress as lawmakers on both sides debate whether or not to raise the debt ceiling to allow the U.S. government to borrow more money. A government shutdown is certainly possible, if not likely. How do you think it's going to play out, and how will markets respond?
Well, let's hope they don't respond the way they did in 2011. Generally, they wait right up until the very last minute. Both sides will stand in their corners and say, we're not giving an inch, and then they'll meet somewhere in the middle. That's been the history of this. I expect that to be the same case. But in 2011, when we took it right up to the edge, it took less than 2 weeks for the S&P to give up about 17, 18%. What was interesting back then, it was that bonds actually rallied into that. So we'll see how that plays out this year. But we'll get beyond that, but not without some consternation.
Okay, let's go to some stocks that you do like in this difficult market. One is Albemarle.
Yeah, ALB. Every now and then, a secular growth story has a moment in time when they stumble. And this group got rocked. ALB is in the lithium business. They're a specialty chemical maker. There was a Chinese battery company that set a ceiling of $30,000 per metric ton for lithium. That was about 50% under the going rate. I don't think anybody thought that lithium prices were going to stay as elevated as they were. So the whole sector got slammed. I don't think EVs are going away, and I think this is well discounted in the price of the shares, trading well under 9 times earnings. This is a company that's going to have about a 50% boost in revenue this year. So look, it's a commodity stock. It's volatile, so I would size it accordingly.
Healthcare stocks tend to be a perennial favorite among people we speak to who watch the U.S. markets, but I gather they've sold off recently.
Yeah, they have 10 straight weeks. You know, Wall Street has a habit of rushing from one side of the lifeboat to the other. And last year, everybody was hiding out there, including yours truly, because the free cash flow metrics were just so good. I don't think any of that's really changed. But so far this year, anything that did well last year got thrown overboard. So if you can't buy an individual stock or you're not sure what to buy, I'd buy the sector itself, buy the basket, buy the XLV, even if you just want to play it for a bounce. The reversion to the mean trade is very, very powerful, and the valuation multiples on this are pretty respectable.